Investing is one of the most powerful ways beginners can turn small amounts of money into long-term wealth. But most people never start because they think they need a lot of capital or deep financial knowledge. The truth is, even small, consistent investments can grow significantly over time when combined with patience, discipline, and the right strategy. In today's world, beginners have access to stocks, ETFs, crypto, and other simple investment tools that make wealth building more accessible than ever. In this video, we'll break down a beginner-friendly investing guide that shows how small money can grow into big wealth step by step. Today we will talk about Beginner Investing Guide. Turn small money into big wealth. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why small money can still build big wealth. Investing is often misunderstood as something only rich people can do, but in reality, it is one of the most accessible wealth-building tools available today. Even small amounts of money can grow into significant wealth over time if invested consistently and wisely. The key principle behind investing is compounding, where your money earns returns, and those returns generate even more returns over time. In today's digital world, beginners can start investing with very small amounts through stocks, ETFs, mutual funds, and even fractional investments. The real difference between those who build wealth and those who don't is not income level, but consistency, patience, and understanding how money grows over time. 2. Understanding the basics of investing. Before putting money into any asset, beginners must understand what investing actually means. Investing is the process of putting money into assets that have the potential to grow in value over time. These assets include stocks, index funds, real estate, and other financial instruments. Unlike saving, which keeps money safe but stagnant, investing allows money to grow. However, every investment carries some level of risk. The goal is not to avoid risk completely, but to manage it wisely. Beginners should start by learning basic concepts such as risk versus reward, diversification, and long-term growth. 3. Starting small, the power of consistency over amount. One of the biggest myths in investing is that you need large amounts of money to begin. In reality, starting small is not only acceptable, but often better for beginners. Even investing $10 to $50 regularly can build strong financial habits. The key is consistency, not size. By investing small amounts regularly, beginners learn how markets move, how emotions affect decisions, and how long-term growth works. This stage is not about making big profits. It is about building discipline and understanding the investment process without taking major risks. 4. Choosing simple and safe beginner investments. For beginners, the safest and most effective starting point is usually index funds or ETFs, which spread money across many companies and reduce risk. These investments are less volatile compared to individual stocks and are designed for long-term growth. Another option is blue-chip stocks, well-established companies with stable performance. Beginners should avoid complex or highly speculative investments in the early stages. The goal is stability and learning, not quick profit. By starting with simple assets, investors reduce the chances of emotional mistakes and financial losses. 5. The power of compounding, turning time into wealth. Compounding is the most powerful force in investing. It means that your money earns returns, and those returns start earning their own returns over time. For example, small investments made consistently over years can grow into large sums without needing large one-time deposits. The longer money stays invested, the more powerful compounding becomes. This is why time is more important than amount in investing. Beginners who start early, even with small amounts, often outperform those who start late with larger capital because they give compounding more time to work. 6. Diversification, protecting your money while it grows. Diversification is the strategy of spreading money across different types of investments to reduce risk. Instead of putting all money into one stock or asset, beginners should invest in multiple areas such as index funds, ETFs, and possibly bonds or other stable assets. This ensures that if one investment performs poorly, others can balance the loss. Diversification is not about maximizing profit in the short term, but about protecting long-term growth. It is one of the most important principles in building sustainable wealth through investing. 7. Emotional control, the hidden factor in investing success. Most beginners fail in investing not because of bad investments, but because of emotional decisions. Fear and greed are the two biggest enemies of investors. Fear causes people to sell too early, while greed causes them to take unnecessary risks. Successful investors learn to stay calm during market ups and downs. They focus on long-term goals instead of short-term fluctuations. Emotional discipline ensures that investment plans stay consistent, which is essential for building wealth over time. 8. Long-term strategy, turning small money into big wealth. The final step in beginner investing is building a long-term strategy. Wealth is not created overnight. It is built through consistent investing over years. Beginners should focus on regular contributions, reinvesting returns, and avoiding unnecessary withdrawals. Over time, small investments grow significantly through compounding and market growth. The key is patience and discipline. Those who stay invested for the long term benefit from exponential growth, while those who constantly withdraw or panic lose potential gains. Turning small money into big wealth is not about timing the market. It is about time in the market. 9. The real secret behind beginner investing success. The real secret to beginner investing is simple. Start early, stay consistent, and think long-term. You do not need large capital to begin, but you do need discipline and patience. By understanding basic investing principles, starting small, choosing safe assets, using diversification, and controlling emotions, anyone can begin building wealth over time. Investing is not a quick money strategy. It is a long-term wealth-building system. Those who respect the process eventually turn small amounts of money into significant financial freedom through consistency and time. 10. Avoiding the biggest beginner investing mistakes. Most beginners don't lose money because investing is impossible. They lose money because they make emotional and uninformed decisions. One of the biggest mistakes is chasing hot tips or trending stocks without understanding the underlying asset. Another common mistake is trying to time the market instead of staying invested consistently. Beginners also often panic during short-term drops and sell a loss, locking in mistakes instead of allowing recovery. Successful investors avoid these behaviors by sticking to a simple plan, ignoring noise, and focusing on long-term growth instead of daily market movements. 11. Building the habit of regular investing, dollar-cost strategy. One of the most powerful habits in beginner investing is investing regularly, no matter what the market is doing. This approach is known as dollar-cost averaging, where a fixed amount is invested at regular intervals. It removes emotional decision-making and reduces the risk of entering the market at the wrong time. Over time, this strategy smooths out price fluctuations and builds consistent wealth growth. The key advantage is discipline. By investing automatically, beginners build financial momentum without needing to constantly analyze market conditions. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.